Welcome to Echo 315, Study Session 10, Cost of Capital, Introduction. In the previous study session, we observed that the discounted cash flow method of investment appraisal is greatly affected by the discount rate, and selection of the proper rate is critical to making the right decision. In this study session, you will examine how to calculate cost of capital for debt, preference stock, equity, and for the entire firm. Learning outcomes. When you have studied this session, you should be able to 1. Explain the concept of capital cost. 2. Discuss the importance of capital cost. 3. Enumerate the forms of capital cost. 4. Describe how cost of capital is calculated. 5. Highlight the difference between cost of preference capital and cost of debt. 6. Discuss the forms of cost of equity. 7. Explain the weighted average cost of capital. Concept of cost of capital. Cost of capital can be defined as the discount rate used in evaluating the desirability of investment projects in capital budgeting. It can also be defined as the minimum rate of return required on an investment project. It is indeed the cut-off or the target or the hurdle rate that maximizes the value of the firm when it is rationally applied in evaluating the desirability of investment projects. Thus, it can also be defined as the minimum rate of return which maintain the market value per share at its current value. If a project earns more than the cost of capital, the market value of the project on per share basis is expected to increase. It is simply the rate of return that the funds used by the firm should be produced to justify their use, given the wealth maximization objective of the firm. Importance of cost of capital. 1. It is very useful as a tool for deciding criteria in capital budgeting decisions. 2. It is helpful in designing the firm's capital structure. The objective must be to minimize the cost of capital and maximize the market value of the firm. 3. It is very useful in making decisions about methods of financing. 4. It can also be used to evaluate the financial performance of management, e.g., comparing profitability of product with overall cost of capital and also determining the overall cost of raising capital. 5. It is useful in other areas of financial decisions, e.g., dividend and working capital policy. Forms of cost of capital. Future cost. Investment projects are usually appraised using future cost of capital and not the historical cost by comparing the project's expected internal rate of return and the expected cost of funds. Historically, costs are only useful in predicting the future cost and makes for the evaluation of the past performance with standard cost. Special costs and combined costs. To accept a project, its profitability should be evaluated on different cost bases depending on the specific source of fund using the financing of the project. In the long run, the firm is expected to maintain a balance between debt and equity components of financing. Therefore, cost of capital is used in the composite sense. The composite or combined cost of capital is an all-inclusive cost of capital from all sources, that is debt, equity, preference shares, etc. The combined cost of capital is called the weighted average cost of capital. In capital project evaluation, the composite cost of capital should be used as an acceptable criterion even when the firm may use equity or debt to finance it. It is the overall mix of financing that is of absolute importance. Explicit cost. The explicit cost of capital is the discount rate that equates the present value of cash inflow that is incremental to the taking of the financing opportunity with the present value of its incremental cash flow. Outflow in this area should be in the form of interest payment, principal payment, and or dividends. Explicit cost of capital arises only when capital is raised. The explicit cost of capital is defined as the internal rate of return of the cash flow associated with financing opportunity. Implicit cost of capital. This is also known as the opportunity cost of capital. It is the rate of return associated with the best investment opportunity for a firm and its shareholders that will be foregone if the project being considered by the firm is finally accepted. Implicit cost arises only when the firm considers alternative uses of the fund raising for investment purposes. Cost or debt. The cost of debt capital already issued is the internal rate of return, which equates the current market price with the discounted future cash flows or cash received from the security. In the case of irredeemable debt, the future cash flow are the interest or dividend payment in perpetuity, so that P1 equals C bracket 1 minus K to power 2 plus C over 1 minus K all squared equals CK. It implies that K equals C over PT, where PT represents current market price of debt capital after current coupon, C periodic interest or coupon payment, K before tax cost of debt. Debt can be issued both at par or at a premium or a discount. Cost of irredeemable debt is the rate of return expected by the leaders to redemption. If the debt is irredeemable, it means that in the year of redemption, the interest payment will be received by the holder along with the amount payable. The cost of debt is a discount rate that equates the periodic cash flow and the redemption value to the current market price of debt. For debt redeemable at par in 10 years, P1 equals C bracket 1 plus K to power 1 plus C over 1 plus K to power 2 and so on. The calculation of K is usually through trial and error method. When a bond or debenture is issued at par and is to be redeemed at a future time, then the before tax cost of debt is before tax K equals I over P, which is equal to interest over principal. In the course of issuing debt, flotation costs in form of legal fees, administrative expenses, brokerage, underwriting, commission, etc. are often incurred. The effect of the flotation cost is to reduce the proceeds of the issue, thereby increasing the cost of debt. Interest paid on debt is tax deductible. The higher the interest charges, the lower the tax payable. Thus, in the calculation of cost of debt, the calculated rate is adjusted for the tax purposes at the applicable rate. After tax of debt, A equals K of 1 minus T, where T is the corporate tax. The tax benefit of interest deductible is only available to profitable firms paying taxes. An unprofitable firm does not pay tax and therefore would not gain any tax benefit associated with interest payments. Therefore, the true cost of debt is the before tax cost. When debt is issued at a discount or at a premium, the cost of debt will not be equal to the coupon rate of interest. The appropriate cost can be determined thus: L0 equals C1 bracket 1 plus 4 to power 1, C2 over 1 plus K all in bracket to power 2, where IO equals net cash inflow in year 0, C1, C2, C3 cash flow in periods 1, 2, 3 and so on. K equals before tax cost of debt. An alternative appropriate formula is given as K1 equals 1 minus T all in bracket times R, capital R, plus I divided by N times F minus P divided by F plus P, where F equals face value of the debt instrument, P price at which the debt is sold or issued, R equals fixed interest charges, N number of years of maturity, 1 over N, F minus P equals amortization for premium or discount. Cost of preference capital. Unlike debt capital, there is no appreciable legal binding obligation on the firm to pay interest. Even the dividend when paid are not chargeable earnings. Rather, it is distributed or appropriated to a class of owners. In valuation, preference shares are treated as perpetual security if it is irredeemable. Therefore, the cost is K0 equals D0 divided by P, where K0 equals cost of preference capital, D0 equals periodic preference dividend payment, and P equals the current market price of the preference capital. The cost of preference is not adjustable for tax purposes because dividend on preference is paid after tax. Thus, the cost of preference is often greater than the cost of debt. Where preference capital is redeemable, the cost calculated from P1 equals C1 divided by 1 plus K0 to power 1 plus C2 divided by bracket 1 plus K2 square and so on, where C1 through 3 are periodic dividend payment, K0 equals cost of preference capital. An alternative formula is given as K0 equals R plus 1 divided by N of F minus P divided by 1 over 2 F plus P, where F face value of the debt instrument, P equals price at which the debt is sold or issued, R equals fixed interest charges, N equals number of years to maturity. Cost of equity. The cost of equity is the required rate of return which equates the present value of the expected dividend with the market value of the share. For the purpose of evaluation, equity capital will be divided into external equity or new issue of common stock, and then 2, retained earnings. The cost of external equity is often higher than the cost of retained earnings because of fluctuation in cost. It is very difficult to measure the cost of equity because it is difficult for estimating future dividend. 2. Earnings and dividends on common shares are expected to grow. The computation of that growth for recognition in the explicit cost of common equity is a problem. Dividend valuation model. The dividend valuation model postulates that the cost of equity is the return expected by the shareholders. The return is expected to flow from the streams of dividend expected by shareholders. The dividend valuation model is based on certain assumptions. 1. There must be no increase in the cost of capital. 2. All shareholders have profit information about the company future. 3. All shareholders have the same marginal cost of production. 4. There will be no issue expenses for new shares. 5. Taxation. Shared cost of capital. Share issues, whether new or right issue, normally involves cost and so should be included in capital cost computation. There are 2 approaches, namely Carlsberg approach. Under this approach, issue cost should be deducted as a year 0 cash outflow of the project for which the share capital is being raised. Thus, the issue cost will not affect cost of capital. Alternative approach. The alternative approach is to net off issue cost in the process of valuation using the formula K equals D divided by MV minus X, where X issue cost, D equals dividend, MV equals market price of stock. In practice, approach R is popular, where only a fraction of the share price is paid as fluctuation costs. The cost of new issue of shares will be estimated as follows. K naught equals D divided by MV bracket 1 minus F bracket close plus G. Dividend growth model. Shareholders do not expect dividend to remain constant, but expect it to grow or increase year by year. The fundamental theory of share values states that the market price of a share is the present value of the discounted cash flows of revenues from the growth in dividend. It is often convenient to assume a constant expected dividend rate in perpetuity. That is, MV equals D naught bracket 1 plus G bracket close K naught minus G. This implies that K naught equals D of 1 plus G of MV plus G, or K equals D MV plus G, where D equals D naught. Cost of retained earnings. Retained earnings involve an opportunity cost. The opportunity cost of retained earning is the dividend forgone by shareholders. K naught equals D over P naught plus G, where K is the cost of retained earnings. Weighted average cost of capital. The average cost of capital is the weighted average cost of each component of funds employed by the firm, the weight being the proportion of each component in the capital structure. There are three major problems encountered in the computation of the weighted cost of capital. They are: 1. Problems of measuring the cost of specific capital. 2. Problems of assigning appropriate and unambiguous weight to each component of capital, e.g., do you use market values or book values? 3. The effect of changes of capital weight on the cost of capital. Summary. In this study session, you learned that capital costing is a very useful tool as a decision criterion in capital budgeting and financing decisions. It is the minimum rate of return required on an investment project. We can distinguish between future costs, special costs, explicit costs, and implicit costs of capital. The cost of debt capital already issued is the internal rate of return, which equates the current market price with the discounted future cash flow. The cost of preference is not adjustable for equity, is the required rate of return, which equates the present value of the expected dividend with the market value of the share. The average cost of capital is the weighted average cost of each component of fund employed by the firm. This is the end of study session 10. Thanks for listening.